Hey everyone, welcome back to the channel. If you're new here, hit that subscribe button because we're diving into one of the most important silver market updates of 2026. Right now, as I'm recording this on February 17th, silver is trading at $74.43 per ounce. Now, if you're just tuning in and you haven't been following the silver market closely, that number might not mean much to you, but I want you to understand the context of where we are right now. Just weeks ago, on January 29th, silver hit an all-time nominal high of 121.67 per ounce. That means in less than 3 weeks, silver has lost approximately $47 per ounce, or roughly 39% of its value. That's a massive correction, and it's left a lot of investors confused, scared, and wondering what happens next. Is silver finished? Is the bull market over? Or is this just a healthy correction in a much larger move upward? By the end of this video, you're going to have a complete understanding of where silver is right now, why it crashed so dramatically, and most importantly, where the market is likely headed over the next 6 to 12 months. Let me start by giving you the complete picture of what's happened with silver over the past year. At the beginning of 2025, silver was trading around $30 to $32 per ounce. By the end of 2025, after a spectacular rally, silver had surged to somewhere in the $80 to $85 range. That's a gain of roughly 160 to 170% in a single year. Then, in January 2026, something even more dramatic happened. Silver entered what traders call a parabolic phase, meaning prices started rising at an accelerating rate. In just 4 weeks, silver went from $80 to $121.67. That's a gain of over $40 per ounce in a month. Now, price movements like that don't happen by accident. Something was driving this incredible surge, and it's important that we understand what that was. The first thing you need to understand is the fundamental supply and demand situation for silver. This is not speculation. This is not hype. This is cold, hard market data that tells a fascinating story. For 6 consecutive years, the world has been consuming more silver than it's producing. That's not 4 years of shortage. That's not 5. That's 6 years running, where demand exceeds supply. In 2026 alone, analysts are projecting that global silver demand will exceed supply by approximately 67 million ounces. Now, 67 million ounces might sound like a number that could be fixed relatively quickly, but when you realize that we've accumulated a cumulative deficit of roughly 820 million to 900 million ounces over the past 5 years, you understand that we're talking about a structural, deep shortage, not a minor imbalance. Here's the critical part that most people don't understand about silver supply. Unlike most other commodities, silver is not primarily mined for silver. Approximately 71% of the world's silver is produced as a byproduct of gold, copper, lead, and zinc mining. Think about what that means. If you're a copper mining company and copper prices are depressed, you might shut down your mining operation entirely. When you do that, you lose not just copper production, but also all the silver that comes with it. The copper company isn't going to say, well, silver prices are high, so let's keep mining copper at a loss just to get the silver. That's not how business works. This creates what's called supply inelasticity. No matter how high silver prices go, mining companies can't just flip a switch and produce more silver. They're constrained by the economics of the metals that are their primary focus. The demand side of the equation is equally compelling. Solar energy is consuming more silver than ever before in history. Every solar panel contains between 15 and 25 grams of silver. The International Energy Agency is forecasting that solar installations could quadruple by 2030. That's not a small increase. That's a 300% expansion in a 4-year period. When you multiply that by the amount of silver in each panel, you're looking at exponentially growing demand for silver from solar alone. Then there's the electric vehicle revolution. Electric vehicles require 67 to 79% more silver per vehicle compared to traditional internal combustion engine cars. Why? Because electric vehicles have infinitely more complex power electronics and control systems. As EV production accelerates globally, particularly in China where production is absolutely exploding, that creates another massive source of silver demand that didn't exist 10 years ago. Then there's a brand new demand driver that emerged in 2025 and 2026, artificial intelligence data centers. Thousands of new data centers are being constructed around the world to support AI infrastructure. These data centers require massive amounts of electrical connectivity, switching equipment, and power distribution hardware. Silver is the best electrical conductor available, and it's the only practical choice for many applications. This is creating a whole new category of silver demand that's expanding rapidly and will likely continue to expand for many years to come. On top of all this, something remarkable happened that most people completely missed. Central banks from emerging market countries began accumulating silver in 2025. This is significant because central banks don't typically buy silver unless they consider it strategically important. When they do, it signals that they're treating it not just as an investment, but as a monetary asset and a hedge against currency debasement. This central bank demand is a structural shift that wasn't happening before and is likely to continue for years. All of these factors combined to create a perfect storm in January. Demand was accelerating, supply was constrained, central banks were buying, industrial users were desperate to lock in supply, investment demand was surging as people realized how tight the market actually was. Then something happened in the derivatives markets that accelerated the entire move. The CME, which operates the COMEX silver futures market, raised margin requirements twice in the 2 weeks leading up to the peak. Margins went from 9% to 11%. For traders operating with leverage, this was significant. Suddenly, positions that had slim margins became uncomfortably tight. When prices started to accelerate higher, there was increasing danger that positions would be automatically liquidated if prices moved against them. On January 29th, silver hit 121.67. The very next day, January 30th, something triggered a complete reversal. President Trump announced his nomination of Kevin Warsh as the next Federal Reserve Chair. Warsh is perceived as hawkish, meaning he favors higher interest rates and tighter monetary policy. The market interpreted this as a signal that the Federal Reserve might keep rates higher for longer. Now, precious metals like silver become less attractive when interest rates rise because they don't pay any interest. Additionally, when rates are higher, the US dollar tends to strengthen, and precious metals become more expensive for buyers using other currencies. This triggered selling. But what happened next wasn't just normal selling. It was a cascade of automatic liquidations. As prices fell, traders with tight margin positions got liquidated. Their positions were sold automatically by their brokers to raise cash and meet the new margin requirements. As those positions were liquidated, prices fell further, triggering more liquidations. This created a self-perpetuating panic. Imagine a snowball rolling down a hill, getting bigger as it rolls. That's what happened to silver prices. In a single day, silver crashed from $121.67 to around $78, losing $43 per ounce, or approximately 35% of its value. The situation was so severe that the Shenzhen Stock Exchange in China had to suspend trading in the primary silver investment vehicle for Chinese retail traders just to prevent a total meltdown. The data on what happened next is striking. In the week following the crash, 33.45 million ounces of silver were physically withdrawn from COMEX registered vaults for delivery. That represented 26% of the entire registered inventory in a single week. To put that in perspective, that's an enormous amount of physical silver leaving the vaults. It signals that people who had positions in the futures market decided they didn't want to trust in the system anymore. They wanted actual physical metal in their possession. That kind of behavior, called a run on the banks in financial terms, only happens when people lose confidence in the system or believe that supply is genuinely constrained. Now here we are in mid-February 2026. Silver is trading at $74.43, down $47 from the January peak, but still up significantly compared to where it started the year at around $80 to $85. The critical question is whether this correction has finished or whether there's more downside to come. My analysis of the data suggests that the answer is nuanced. On one hand, the speculative excess that drove prices to $121.67 has clearly been purged. Leverage has been liquidated. Profit-taking has occurred. The psychological damage from the crash is real, and it will take time for confidence to return. However, and this is absolutely critical, the underlying fundamental factors that drove silver higher haven't changed at all. The supply deficit is still there. In fact, it's worse than ever because the depletion of above-ground stocks continues. China's export licensing controls that went into effect on January 1st, 2026 are still in place. Those controls effectively restrict refined silver exports to just 44 companies and require a $30 million credit line for participation. This policy ring-fences 60 to 70% of global refined silver supply within China's borders. It's a dramatic move by a major government to control and secure supplies of a critical material. That policy hasn't changed. The geopolitical significance of it hasn't diminished. Industrial demand for solar, electric vehicles, and AI infrastructure continues to accelerate regardless of where prices are trading. These are not speculative demands. These are real, underlying structural demands that will exist whether silver is trading at $74 or $120. The fact that prices have corrected doesn't change the reality that solar installations are growing, EV production is growing, and data center construction is accelerating. All of these factors continue to create a fundamental supply-demand imbalance. The backwardation in the market, which I explained earlier, is still present, though not as extreme as it was in late January. Backwardation means the spot price is higher than the futures price, signaling urgent demand for immediate physical delivery. The fact that it still exists tells us that the underlying physical tightness remains real. The panic has subsided, but the actual shortage hasn't. Looking at the expert forecast for where silver could go, we see a wide range of opinions. Citigroup is calling for silver to reach $150 per ounce by mid-2026. Commerzbank, a major German bank, has raised their forecast to $92 to $95 per ounce by year-end 2026. More aggressive forecasts suggest silver could reach $200 to $260 by the end of the year. The range of forecasts alone tells us that there's genuine disagreement, but notice that almost all the major institutional forecasts are higher than current levels. That's significant. My base case scenario for the next 6 to 12 months looks like this. Silver consolidates in the $70 to $85 range through the spring and into the early summer of 2026. During this consolidation period, the market catches its breath after the January volatility. Leverage gets rebuilt slowly and cautiously as traders gain confidence that the crisis has passed. Industrial buyers continue to accumulate physical silver to secure supply. Central banks continue their strategic accumulation. Physical withdrawals from COMEX continue at a steady pace as the deficit continues to grow. By late summer or early fall of 2026, as the market realizes that the underlying supply situation continues to deteriorate, and as the consolidation phase validates the breakout, silver begins to move higher again. In this scenario, silver could reach somewhere between $100 and $110 by the end of 2026. If that level holds and investors gain confidence in the bull thesis, we could see silver challenge $150 to $175 in 2027. In a more aggressive scenario where central banks accelerate their accumulation and investment demand returns strongly, silver could move even higher. However, I want to be honest about the risks. There are scenarios where silver could move lower. If the global economy entered a significant recession, industrial demand could weaken. If the Federal Reserve actually raised interest rates and maintained them at elevated levels, the dollar could strengthen significantly, which would reduce demand for non-yielding assets like silver. If technological breakthroughs discovered ways to reduce silver intensity in solar panels or electronics, that would lower long-term demand. If substitution materials became viable, that could also reduce demand. These risks exist, but based on the current data and trends, I believe they are less likely than the bullish scenario. Let me break down what I think is going to happen in the coming months. The $70 to $85 consolidation range is where we're likely to stay through May or June. This is healthy market action. It allows speculators to exit, it allows intelligent buyers to accumulate at better prices, and it allows the psychological wounds from January to heal. During this time, keep your eye on COMEX inventory data. If we continue to see large physical withdrawals week after week, that's a sign that the market is tight and positions are being converted from paper to physical. That's bullish for the long-term price. Also watch the gold to silver ratio. Right now it's sitting around 74 to 1, meaning it takes 74 ounces of silver to equal the value of 1 ounce of gold. Historically, that ratio has been around 60 to 70. When silver is in a bull market, this ratio tends to compress significantly. If the ratio compresses towards 60, that means silver is outperforming gold. In previous bull markets, the ratio has compressed to 40 to 1, or even lower. That compression could drive significant outperformance for silver. Pay attention to China's economic data and government policies. China is the dominant force in global silver consumption through solar and EV production. If China's economy stumbles, that could reduce demand. Conversely, if China accelerates its renewable energy transition, that could accelerate silver demand. The fact that they implemented export controls on January 1st tells us they're serious about securing supply. That's a bullish signal. Watch for new all-time highs in solar installations. Each gigawatt of new solar capacity requires approximately 15 to 25 million ounces of silver, depending on the technology. If we're on track for 500 gigawatts annually by 2030, and we're currently around 250 gigawatts per year, that means solar demand alone could double. That's structural demand growth that will support higher silver prices. Here's what I want you to understand about silver right now. The crash from $121 to $74 was painful, but it was also healthy. It cleared out the leverage, the speculation, and the excessive positioning that had accumulated. What remains is a much more solid foundation based on real supply-demand fundamentals. The price at $74.43 today is actually quite attractive for long-term accumulation if you believe in the structural bull thesis for silver. If you're thinking about buying silver, I would recommend dollar cost averaging. That means buying a fixed amount at regular intervals over time. This strategy smooths out your average cost basis and removes emotion from the decision-making process. Don't try to catch the bottom. Don't wait for silver to go lower. Buy consistently at whatever the current price is and build your position over time. Whether you're buying at $74 or $80 or $85, if you believe silver is going to $150 to $200 over the next 2 years, the difference between these prices becomes almost insignificant. The silver market is in a consolidation phase, gathering strength for the next move higher. The fundamentals are intact. The supply situation is worsening. Industrial demand is growing. Strategic buyers are accumulating. The pieces are all in place for a significant move upward in the months ahead. What we're witnessing right now at $74.43 is an opportunity, not a crisis. The next chapter of the silver bull market is being written right now. The question is whether you're going to be part of it or whether you're going to look back a year from now and wish you had acted when silver was consolidating in the $70 to $85 range. Thanks for watching, and I'll see you in the next video.